Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. And on today's video, how to operate a self-directed IRA. So I've got a lot of requests for this subject. People said, hey, Adam, can you just give us a nice short video and explain to us all the key items that we need to consider, identify, remember when operating a self-directed IRA. So when we set this up with you or with another company, what do we need to keep in mind? Okay, so I said, you know what, it's a great idea. Sure, we provide a lot of content, a lot of information, weekly newsletters, things like that to all our clients, but you're right. I should do more of just basic rules, items to know if you want to operate a self-directed IRA in full IRS compliance. So guess what? That's what I'm going to do today. So if you have a self-directed IRA or a self-directed IRA LLC, you need to watch this. For the next 20 or 30 minutes, I'm going to basically highlight all the key points that you need to know to properly operate your self-directed IRA in full IRS compliance. So I'm going to start and go through contributions, go through how to do distributions. I'm going to talk about a full service self-directed IRA, the checkbook, and then I'm going to, through the checkbook funnel, I'm going to talk about LLC state filing fee obligations. I'm also going to talk about tax filing reporting requirements, and then go into prohibited transactions, UBIT, and maybe some other nuggets at the end. So it's going to be a fact-filled next 20 or so minutes, but buckle up. This is all you're going to need to know if you want to properly operate your self-directed IRA. Let's start. So what an IRA is, it's an individual retirement account. You guys, if you're watching this video, you know what an IRA is. You know what a self-directed IRA is. It's essentially an IRA that lets you invest in alternative assets, right? No secret. Since 1974, when IRAs were created, self-directed IRAs were created along with IRAs. Self-directed IRA is not a different type of IRA. It still follows all the IRA contribution, distribution rules. The only difference is that the custodian of the IRA, i.e. IRA Financial, lets you do alternative assets versus Fidelity or Schwab that lets you just do traditional investments. Why? Just the business model. We don't make money selling investments. We're not fiduciaries. We don't give investment advice. So we have a different business model than the Fidelities of the world that do make money by providing products and selling investments. So that's the only difference between an IRA and a self-directed IRA. That's it. So you probably know that. Two types of self-directed IRAs. There's a full service self-directed IRA where the self-directed IRA is actually making the investment into the alternative asset, whether it's real estate or a hedge fund or a crypto. So title in that asset would be IRA Financial Trust Company for the benefit of the Adam Bergman IRA. And that's probably the most common way to invest in alternative assets. You basically open an account with the IRA custodian. You move the money tax-free to the IRA custodian, whether it's a transfer from another IRA custodian or a rollover from a former 401k employer or 403b or 457b. And then once the money has arrived at the custodian, you tell the custodian where to send the money, and we send the money, and then hopefully all the income and gains will flow back into that IRA tax-free. The IRA custodian is essentially the trustee of the IRA and handles all IRS reporting requirements, including 5498, which is the annual IRA valuation required to be filed by the IRS by the end of May. 1099-Rs if you're doing distributions, conversions, things like that. So we take care and keep your IRA in full IRS compliance. Now, the LLC, since 1996 or so, the first case that came out, Swanson v. Commissioner, that essentially formulated the legacy of the self-directed IRA LLC and said, hey, an IRA could own an entity, and that entity could be managed by the IRA owner without triggering a prohibited transaction. So since the Swanson case was unleashed, a number of other IRS private letter rulings and other tax court cases have formulated the concept of a self-directed IRA LLC And now it's essentially in the instructions for the partnership 1065, where it talks about if IRAs are an owner of an LLC. So it's established law. I remember when I started this business, like 2009, 2010, there were still companies out there saying you can't use an LLC wholly owned by an IRA, and it was still a thing, believe it or not, all the way up until like the 2014, 15, when everyone realized that, hey, like this is the law. In fact, if you want to get a loan from Freddie or Fannie Mae to buy real estate in an IRA, they're going to make you have an LLC. They will not lend directly to the IRA. They will require you to have an LLC. So things have changed. Obviously, the industry has grown a lot. More and more people understand and appreciate the benefits of alternative assets, of diversification and investing in assets and trust, investing in hard assets. It's helped people hedge against inflation, whether it's real estate, gold, or other assets. So it's definitely a lot more mainstream today in 2023 than it was in 2010. So let's talk about how you make contributions to an IRA. So obviously the contributions need to go to the IRA custodian. Whether you have a self-directed IRA or a self-directed IRA LLC, the contributions need to go to the custodian. You cannot make the contributions to the LLC if you have a checkbook. Okay, the custodian is essentially the vehicle that you need to go through to make any type of contribution or even take a distribution. Why? Because we're the reporting party. So we need to know what's going on so we can properly report that to the IRS. 2023, 6,500 or 7,500 if you're over 50, that's the maximum IRA contributions. You obviously need to have earned income. And I'm not going to go through the details on the earned income. I've done a number of other videos and podcasts on that, which you can refer to. But essentially, if you have access to a 401k and you make above a certain income threshold, you can still do an IRA, but you may not be able to do a pre-tax IRA and get a deduction. Since 2010, everyone can do Roth IRAs thanks to the backdoor Roth IRA. But if you're single and you make more than 153K or married filed jointly make more than 228K, you cannot do a direct Roth IRA contribution, but you can do a backdoor Roth IRA. If you want to take distributions from your IRA or your IRA LLC, again, it needs to go through the custodian. You need to request a distribution. If you're under 59.5, distribution will generally be subject to tax plus a 10% early distribution penalty. If you're over 59.5, in the pre-tax world, you'll pay tax on what you pull out. In the Roth world, so long as you're over 59.5, the Roth has been opened at least 5 years, it's all tax-free, and that's known as a qualified Roth IRA distribution. Valuations, okay, that's first, I guess, item to remember is how do you make contributions? The second is how do you take distributions? Do not take distributions from your LLC. You got to move the money from the LLC back to IRA Financial or your IRA custodian, and then request the distribution from the IRA custodian. Since again, we're that reporting vehicle. It's like home base. You got to go through home base to do everything. Same thing here. You got to go through the custodian to take a distribution. Third is annual valuation. What's your requirements as an owner of a self-directed IRA or a self-directed IRA LLC annually? Okay. The most important is you got to provide a value to the custodian each year as a 1231 what your IRA is worth. Now you got to aggregate everything in that IRA. Same with the LLC. So if your IRA owns 100% of the LLC and it has cash, some real estate, some gold, some cryptos, private equity, you got to aggregate all those together and then give us a value. Now you may say, hey, yeah, I can tell you the value of Bitcoin as a 1231. I can even tell you the value of gold as a 1231. Real estate, yeah, I can go on an online site or maybe talk to my realtor, but maybe I have an investment in a private business. It's my friend's pizza restaurant, or I have an investment in a small venture capital fund. They're not giving me valuations. They don't have to mark to market their value each quarter. What do I do? Well, you have choices, right? You can ask the promoter, the general partner, the manager of that enterprise what the value is. A lot of clients will just use the value they pay for it until there's some type of event that provides a current fair market value, whether it's a sale, whether it's a capital raise, something that gives you a number that you can use. Now, valuations, the IRS is very interested in valuations. Why? They like to know what's going on, right? Government likes to have data, right? It's the way it works. I'm not saying they got drones hovering over us and want to know what we're doing, but they like to know what's going on. It's not just the FBI or the CIA. Government wants to know. The IRS wants to know. Why? Because when you hit RMD age of 73 years old, which is the new requirement in the distribution age, they want to know what the story was. Did you just go from at 70, 180, and now at 73 or 60? They want to see some type of plan. Okay, why? Because when you have to start paying tax at 73, they want to make sure you're paying tax at the fair market value. So if you're just reporting value and you're under 73 years old, you're not taking a distribution of that asset in the IRA, the valuation is an important part of the process and an important part of operating your self-directed IRA, but it's not crucial. Why? Because it's not a taxable event. If you're 46, 57, 64, and you say your IRA is worth 160 and maybe it's worth 152 or 173, it's not really going to matter, right? You want to be close. You want to do as best as you can to give an accurate valuation of the IRAs at 1231, but it's not a taxable event. You're not paying tax on that value. It's simply a reporting requirement. But if you're over the age of 73 and have taken RMD, value matters, right? And that's why we're going to require you to provide a value and have a third party, basically sign off on that value. Cash, cryptos, equities, things that are marketable, traded on an exchange, obviously is super easy to value. More difficult stuff is the illiquid stuff like private business interest, hedge funds, private equity, venture capital. Real estate's not as difficult as it used to be because of all these online sites, whether it's Zillow, Trulia, where you can get a really, really accurate snapshot of the valuation, which the IRS will accept. Wasn't the case 10, 15 years ago, right? 10, 15 years ago, real estate was more difficult. That was the one issue the IRS always had with alternative assets. It wasn't like they had an issue with IRA owners buying alts. If they did, they would not allow for it when they created IRAs in 1974. They would have basically just restricted it to equities, just like 529 plans. 529 college savings plans can only invest in certain investments. The IRS could have done that in 1974. It didn't. Why? They recognized the importance of diversification and alternative assets. But they want to make sure, especially in pre-tax accounts, that you're accurately reporting valuations. Now, some folks say, well, Adam, in Roth, they really don't care. Right? It doesn't matter if your Roth IRA is worth 7 million or 7,000 or 80,000. So long as you're over 59 and a half, Roth's been open 5 years, it's all tax free. What does it matter? True. But let's say you take a premature distribution, right? Let's say you take the asset in kind at age 55. I'm not saying you would do that, but if you did, they want to make sure they know what's going on. So let's say at age 50, you said the real estate was worth 400K. And now at 52, you're taking a Roth IRA distribution, valuing that asset at 90. They just like to know what's going on, right? It's all about data. Government, business, people, we like information. That's why we go on Twitter and social media to just gather as much data and really digest as much as we can. Governments are the same. Okay, so that's how the valuations work. This is the next couple of things I'm going to mention. The next couple of items really pertain to IRA LLCs. So if you have a regular self-directed IRA and you're investing in a hedge fund, private equity fund, and you're not the manager of that investment, you're not going to have to deal with the good standing of that LLC, right? I use my IRA to invest in my friend's pizza restaurant. It's an LLC. My buddy, who's the manager of the LLC, has got to deal with the LLC. I do not have to, right? Same as if I invest in a hedge fund or private equity fund, whoever the general partner or the manager of that fund is, they'll have to make sure the LLC, whether it's Delaware, Wyoming, Nevada, New York, Florida, whatever, is in good standing. What does that mean? Well, they filed whatever's required under the state rules, whether it's paying a fee, whether it's filing a report, could be both, whether it's paying a franchise tax like California, Tennessee, Texas. Each state has very specific rules. Some have nothing, like Missouri, and others like South Dakota, very simple, $50. Basically send in. Florida, you go online and pay. It's like $137. So it all depends on the state. I'm not going to go through all 50 states now. You're a client of IRA Financial. You have this information. You're provided it. You can also obviously call us and we'll customize the information for your particular state. But the thing to remember is if you have a self-directed IRA LLC, you as the manager of the LLC are responsible for keeping that LLC in good standing since you're the manager. It's part of your duties. If it's a full-service self-directed IRA, obviously that's not an LLC. It doesn't file anything with the state. We handle all the IRS reporting. Same with an LLC, self-directed IRA. We handle all IRS reporting. But from the state LLC standpoint, remember, LLCs are filed with the state Secretary of State, not with the IRS. You're responsible as the manager. And if your self-directed IRA is invested in an LLC, like a business or investment fund, the manager of that fund or investment business will be responsible for keeping that LLC in good standing. Same with tax filings, right? You have a self-directed IRA invest in a hedge fund. That hedge fund is going to be treated as a partnership. They'll file a 1065, not you. But if you have a self-directed IRA LLC, you're the manager. If your IRA owns 100% of that LLC, good news is it's a disregarded entity for tax purposes. No federal income tax return is required. Right? That's the beauty of the single member LLC. Disregarded entity is treated as a tax nothing, tax invisible. Still respected most cases as a legal entity, but from a tax standpoint, there's no tax return if it's a single member LLC. Whereas if you have an LLC owned by two or more parties, treated as a partnership, and that entity must file a 1065 along with the respective state tax return. If you have a self-directed IRA LLC and you're the manager of the LLC, technically you're responsible to file that return. But if you are a client of IRA Financial and you're smart enough to be a client of IRA Financial, smart enough to be part of our annual compliance service, which is just $299 a year, it'd be crazy not to, you also get the ability to have us file the 1065 for free. Yeah, I just said it, for free. So we handle that. Okay, we'll file the 1065 and the respective state return. Okay, so it's basically a full service, right? If you have a self-directed IRA, no LLC, IRA Financial Trust will take care of the 5498s and any 1099Rs. If you use the self-directed IRA LLC, IRA Financial Trust will still do 5498 and 1099R, and then IRA Financial Group will do the 1065 if it's a partnership, as well as any other important requirements. The only thing you as a manager specifically need to do is pay for the LLC costs. Why? You're the manager. It's just be impossible for us to do it with all the clients we have. And you're in the best position since you can use the IRA LLC funds to just pay for the actual LLC filing. So again, single member LLC, no partnership returns, a disregarded entity. If you have an LLC with two or more owners, it's treated as a partnership, Form 1065 along with the K1, which is an attachment to the 1065, is filed. That's due by March 15th, so it's coming up. So if you're a client of IRA Financial and you have two owners or more of your LLC that you manage, how do you know if you have a multiple member LLC? Well, you probably should know who owns your LLC, but if you just don't remember, you can always look at the operating agreement and flip to the back, and on the Exhibit A, which is like the cap table, if you see one IRA, it's a single member LLC. If you see two IRAs or more, you got a partnership, and you got to file the 1065 by March 15th. Again, you can have us do it. We'll file the extension because it's getting close, and then we'll have until September 15th to help file this for you. We do it for you. Okay, so long as you are a client of ours and have paid our annual compliance fee, which is $299 a year flat, and that doesn't just include the tax return filing; it includes all tax consultation as well, and access to all our amazing team of tax professionals, advisory services, exclusive webinars, all this stuff. Most people, I'd say like 90% pay it, but I'm still surprised how people just like refuse to pay for $299, and then they have a question and they want us to help them, and we're like, hey, you haven't paid us, we'll still help you, of course, but like, you think anyone's going to answer your questions? You're going to go get a lawyer, a tax lawyer, an accountant to answer your question for free? So it's mind-boggling. People are people. What can you say? But thankfully, we have, I'd say 90+% of our clients are smart and understand and appreciate value and actually want to get this right. So we're very proud of our service. We actually don't make much on it because of all the services we provide, but it's done really to keep you guys in good standing. That's the whole point of it, to be honest. Let's now move into the prohibited transaction rules. Okay, this applies to all IRAs, whether it's a self-directed IRA, self-directed IRA LLC. Most of it's facts and circumstances, but let me break it down. There's three things you basically cannot do in an IRA: life insurance, collectibles like art, diamond rings. There's a special carve out for precious metals, pure gold, silver, palladium, American Eagles, bullion coins, bars and coins, 99.9% finesse. But you must hold them at a depository, a U.S. trust company, depository, or the right depository. Make sure they have a trust certification. Make sure they're a regulated trust company, because that would make them a U.S. trustee and allow them to be the depository. There's a lot of depositories out there, a lot of companies out there, I should say, that claim they're a depository, but they're not a regulated trust company. So just ask and make sure they're a regulated trust company, because those are the institutions that are required to hold your IRS approved metals. And then a third broad category is found under Internal Revenue Code section 4975 that lists essentially A, B, C, D, E, and F, 6 things you cannot do with an IRA. And I'll just kind of break them down real quickly. So to have a prohibited transaction, you need two parties. You need an IRA and you need a disqualified person. An IRA, we know what it is. A disqualified person is essentially the IRA owner, any of our lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled 50% or more by such persons. Okay, if you don't have a disqualified person, do not have a prohibited transaction. But there's all kinds of facts and circumstances that we'll get into. So I'm just going to go real quick through 4975 C1A to F and just kind of give you an example for each type of provision. So 4975 C1A says this. The direct, and I'm not going to put it in the chat. You can, if you have any questions, I've done tons of blogs on this stuff. But you can also just Google 4975 and you can read it for yourself, or just listen and watch this video. So A says the direct or indirect sale, exchange, or leasing of property between an IRA and a disqualified person, right? So you can't sell the house that your IRA owns to your son. Okay, remember, disqualified people, parents, children, spouse, daughter-in-law, son-in-law, entities controlled by such persons, brothers, sisters, aunts, uncles, cousins, friends are not DPs. B, the direct or indirect lending of money or extension of credit between an IRA and a DP. So you can't lend your IRA to your IRA money to your parents or your spouse. C, and this is basic stuff, right? You'll see kind of the theme, what's going on. The direct or indirect furnishing of goods or services between an IRA and disqualified person, right? So you can't provide services that aren't required to your IRA. You can't be the real estate agent when your IRA buys a house, okay? Now, D, E, and F are more like the catch-alls, the indirect stuff. The A, B, and C's are the direct. Those are the obvious stuff. D and E and F, the IRS uses more of a catch-all. D says the direct or indirect transfer to a DP of income or assets of an IRA, right? So your son is in jam and you take some money in your IRA and you pay the company he owns more than 50%. So here the money's not going directly to Dan, but it's going to a company he controls. E, the direct or indirect act by a DP who is a fiduciary where he or she deals with the income or assets of the IRA for their own benefit. Fiduciaries are essentially the IRA owner for self-directed IRA purposes. So you basically have your IRA invest in a business you control or have an interest in, and that money and investment is really not benefiting the IRA, but is helping you personally. I.e., even if you own, there's a famous case called Rollins v. Commissioner. I've talked about this case many, many times. 2004 tax court case. It's a perfect example of this provision. They actually used 4975 C1D, but they could have used E and F as well. This guy Rollins was an accountant. He owned less than 50% of the businesses at issue. His 401k lent these companies money at prevailing interest rates. So you would think because he owns less than 50%, the entity is not disqualified, it should be fine. But the IRS and then the tax court agreed and made the argument that because Rollins couldn't prove that the IRA was benefiting from this investment. Why? Because there was an important fact, and that fact was that the companies needed money, and therefore that is why Rollins made the loan to the company, not because it was a good investment from his retirement account, but to help the company, which he had a personal stake in. So that's how the IRS and the tax court uses this indirect prohibited transaction rules as a catch-all to be like, yeah, I know you're under 50%, but we don't like what happened here because we don't think you used your IRA to help, or your 401k, to help your retirement account out exclusively, but we think it was done to help you out personally, and that's not allowed. Okay, so you can see what's going on. It's not direct because he owned less than 50%, but they're using D and F as a catch-all. F, receipt of any consideration by a DP who is a fiduciary for his or her own account for any party dealing with the IRA in connection with a transaction, right? So here you use your IRA to lend money to a business that you work for to secure a promotion, right? You're under 50%, so it should be kosher, but the IRA is making the investment in this company, not because it's a good deal for the IRA, but because you're going to get a promotion or the company's going to be using the money that you invested to pay your bonus or to pay your salary. So overall, two things you need to generate a prohibited transaction, or trigger one, I should say: retirement account and a DP. But even if you don't have a DP, you own less than 50%, you still can potentially trigger the prohibited transaction rules based off the facts and circumstances. And that is why I keep saying it's important to work with a team of tax professionals like we have at IRA Financial that can help navigate these rules with you. We can talk to you. We can explain you tax court cases. We can talk to you about private letter rulings. Just give you insight as to where the IRS will go with this. Now, obviously, we can't guarantee what's going to happen, nor could the best tax lawyer in the world that you pay $2,000 an hour, right? A lot of it's facts and circumstance, but we've been here. We've done this for 13 plus years. We've seen it. We have 25,000 clients. We know what happens. We've been through audits. We know how the IRS acts, and we have insights and relationships where we can ask. So it's important. If you are a client, work with us, talk to us, okay? We'll help you through the process and kind of help you gauge whether this transaction should be done in an IRA. A lot of times we'll tell you, don't do it. Now, ultimately, it's your call, right? It's your money. We can't stop you. But we'll tell you, hey, this is risky. You shouldn't do this or do that based off of these things. So just keep that in mind. Don't be shy. Use us. If you're a client of IRA Financial, take advantage of our expertise. The next thing is S Corp stock. This is not an IRA rule. IRAs cannot own S corporations. Okay, that's a rule under Section 1361. S corps have very peculiar shareholder rules. No foreigners, individuals. 401ks can. Single member LLCs can. But partnerships cannot. Corporations cannot. And IRAs cannot be shareholders of an S corp. So if your IRA invests in an S corp, what will happen? It's not a prohibited transaction, but the S corp election will be blown and the corp will revert back to a C corp. So your other shareholders probably will not be thrilled. Unrelated business taxable income, right? Something you got to be aware of. Remember, the whole intent of today's video is to go through the items, the key points you need to consider when operating a self-directed IRA. I started with the basics: contributions, distributions, right? You want to add money, you want to take money away. We then talked about who's responsible for what from a compliance standpoint. IRA custodian, you as the manager for the LLC if you have a checkbook control. Talked about tax return filings. You as the manager responsible, but IRA Financial will take care of it if you so desire. We then moved into prohibited transaction rules, okay? And we're now talking about unrelated business taxable income. These are just topics that you gotta spot, right? You're doing an investment, think prohibited transaction, right? Is there a disqualified person? What's going on? And then the next thing you need to think about is UBIT, unrelated business income tax. And again, talked about this, I've done lots and lots of videos on this, but in a snapshot, this is how it works. There's 3 ways to trigger UBIT. I'd say 90% of IRA investors will never have to deal with UBIT. They'll never come in contact with UBIT. But if you're doing alternative asset investments, you may. And these are the 3 ways to trigger UBIT. You use a non-recourse loan to acquire an asset like stock, option trading, buying shorts, longs. That is not margin, so that does not trigger UBIT. Number 2, use a non-recourse loan to buy real estate, right? Why am I saying non-recourse, not just mortgage? Because remember, 4975 C1B said you cannot personally guarantee an obligation in your IRA. Just talked about that. So that's why you cannot guarantee a loan. That's why it has to be a non-recourse loan, which is a loan you do not personally guaranteed. Okay. Thirdly, you invest in an active trader business like a restaurant through a pass-through entity like an LLC. I say pass-through because 99% of all publicly traded companies like Apple are C Corps, Tesla. That's why if you're just buying equities, mutual funds, ETFs, fixed income bonds, you're not going to ever have to deal with UBIT, even REITs, because they're corporations. Corporations box in UBIT. There's a corporate level tax of 21%. So the UBIT tax does not apply. But using a non-recourse loan to buy stocks, let's say, non-recourse loan to buy real estate, investing in an active trade or business through a pass-through entity like an LLC, more than $1,000 in net income, you can trigger a UBIT. The UBIT tax goes as high as 37%. That's the maximum tax rate for 2023. And it gets triggered at a very, very low threshold, approximately $14,500. So it's something you got to be aware of, okay? How do you stop it? Well, a couple of things you can do. You cannot use your retirement account because UBIT only applies to charities, tax exempts, and retirement accounts. If you're doing real estate and using leverage, a loan to buy real estate, you can try to set up a solo 401k. There's exemption under 514c9 for 401ks that can use a non-recourse loan to buy real estate without triggering UBIT. How do you get into the solo K world? You need to have a business. Doesn't have to be full time. It could be side business. You can sell, Nike Dunks on eBay, or you can sell seashells on eBay. It doesn't matter. Math tutoring. You can even be Santa Claus. You just need to do something. Okay. Then you could potentially have a solo K and then roll your funds into the solo K and have the solo K buy the real estate with the non-recourse loan without triggering UBIT. You can structure the deal instead of an equity investment into a business as a loan. Interest on a loan is not subject to UBIT. And then you can block it by setting up a corporation. That's called a domestic C Corp blocker. And what that will do is reduce the UBIT tax of 37% down to 21%, which is the corporate tax rate. Not perfect, but not horrible either. And that's what you got to kind of consider with UBIT. Again, this video, I'm trying to keep it within 35 or so minutes. This is just basically being able to spot issues, right? The whole idea is spot an issue, contact IRA Financial. That's what you need to remember. Spot an issue, contact IRA Financial. Hey, maybe doing this deal, I think there could be a DP. Maybe there's a prohibited transaction. I want to talk to you about it. Hey, I'm doing this deal. I'm using a loan to buy real estate. I'm investing in this business or this hedge fund, private equity fund. Is there UBIT? Hey, have a partnership. I have an LLC, 2 or more IRAs. Can you help with the filing? How do you report the UBIT? Let's say you have more than $1,000 in net income. UBIT's filed and reported on a Form 990T due April 15th. We will do it for you as well. Again, another amazing, amazing service that we just launched in 2023. As long as you're a client of IRA Financial, part of our annual compliance service, we will do the 990T. Trust me, that's like a value of probably $1,000. Okay. Go find an accountant that actually knows what a 990T is. It's very specialized. Why? Only charities and retirement accounts file it. So go find one that can do it, and go find one that will do it for less than $1,000. You won't. We do it for $299, including all our other services you receive. People should be knocking down our door to pay this. Most do, but hopefully more and more will get that. We're losing money on this thing. Like, we're doing this for you guys. So we handle this and take care of it for you. Just let us know. One of the last things to consider is conversions, right? This is a popular topic, especially in the last year. Why? Because Roth IRA conversions move pre-tax funds to Roth. And when assets have been depressed like they were in 2022, whether it's cryptos or stocks or private equity hedge funds or private business investments, they were down 10, 20, 30%. The only thing that stayed kind of up is real estate, and it's still relatively strong. So real estate, hard real estate has not been a great conversion asset, but real estate funds, commercial funds, debt funds have. The idea of a Roth conversion, obviously, is you get your pre-tax funds to Roth. Once they're in Roth, they're tax-free. So long as you're over 50 and a half and the Roth's been open at least 5 years, you can pull everything out tax-free, which is the ultimate tax solution. So there's been a lot of interest. I get 10, 15 questions a week on conversions. I wish there was a right answer. There's not. You can pay me $1 million. I still can't tell you whether to do a conversion because you just don't know, right? You don't know what your tax rate will be when you turn 73 or whenever the required distribution age is when you are at that age. I don't know how this investment will turn out. Will this be the next Tesla, or will be this the next, dog investment, right? The next crap coin that went to zero. I don't know. Okay. Can you pay the tax? Only you know. Are you a patient person? Can you wait till you're 59 and a half and the Roth been open 5 years before pulling money out? Only you know. So this is a very personal decision. I can help. I can give you tips. We can all give you thoughts and tips, what you can consider. But ultimately, this is a personal decision that you're going to need to discuss with your family, your spouse, and ultimately you. It's your money. So you're going to have to make that determination. But there are things to consider. Like if you're 80, doing a Roth conversion generally is not as advantageous as if you're 20. Right? You just have less tax growth. If you can't pay the tax, then obviously don't do it. If you have tons of NOLs that can eat up the tax, then yeah, do the conversion. Even if your assets haven't dropped in value, if you can basically reduce or eliminate the tax on the conversion, like, hey, go for it. So again, we're here to help. Clients of IRA Financial, use us. We can help you. Last thing I'd probably say is fees matter. IRA Financial, we have a flat fee model for our IRA custodian fees. It's $400 paid quarterly. It's $100 a quarter. It's like $1. Basically, it comes to like $1 a day. We don't charge asset valuation fees. So we want your assets to go up in value. Gosh, we don't even have transaction fees. We don't have wire fees. Okay, we're literally the only financial institution that does not charge wire fees for any IRA clients. Okay, that's crazy. Yeah, we do it because we care about you. So fees matter. I can't tell you how many people I've spoken to over the years that have been paying like $3,000 a year for IRA custodian fees. And when your IRA is going up 10, 12, 15%, like it's not horrible. But when you have a year like 2022 where your account could have dropped 20% and now you have to pay $2,000, $3,000, $4,000 on top of that, when another company like IRA Financial can do it for a fraction and literally do the same service, it's painful. So, do your diligence. Fees matter. That's your retirement money that's going out to pay fees. Obviously, you're going to have to pay something. Like we do work. We have responsibilities. We have obligations as the IRA custodian. There's risks. So we have to charge you something. But the good companies, and there's some really good ones in the space. It's not just IRA Financial. There's some great companies. Try to keep fees reasonable. Obviously, we've had to deal with inflation and increased costs across the board, which sucks. But we've done our best to, keep our fees low. We have to increase fees over the years, but what we've done is said, okay, we have to increase our base fee, but we'll waive wire fees, or we're not going to impose any annual valuation fees. We're not going to have any transaction fees. We're not having any research fees. We're not going to do additional fees for tax reporting. So we're trying to be fair and reasonable because at the end of the day, we want a long-term relationship with our clients. We hope you keep your IRA with us for 20, 30, 40 years and you bring your family and you can build a huge retirement nest egg with us, and we can build this stuff together. So the last thing I'm going to say is use us. Stay in IRS compliance is key. We have the expertise, right? It's like if you have a toothache, you go and call your dentist, right? You don't just try to figure out why your teeth hurt by calling your neighbor or going on TikTok. So use us, okay? We're here to help. We have amazing team of tax professionals. They're super smart. They often will, give me and send me questions, and they'll basically, spoil me. Where I'll just be like, honestly, I got to research this. Great question. So they'll push me and challenge me, and I love that, and that makes me smarter. So again, operating a self-directed IRA is not difficult. For most of you, there are items to consider and to remember, and just went through all of them in detail. The biggies obviously are, if you have a multiple member LLC, file that tax return. You got to remember prohibited transactions. You have to be able to look at the IRS and the agent in their face and say, hey, no, I did not personally benefit. I did this investment to 100% exclusively benefit my IRA. If you could do that, then you can probably do your investment. But if you can't, think twice, right? So UBIT obviously is that four-letter ugly word that can really turn investments from very tax efficient into very tax inefficient and almost non-starter type investments. And I've told many clients, just don't do it. Use personal funds. Not a good investment for your IRA. And I'll keep saying that. But you got to let us know, right? If you do your deal and call me 6 months later, we can't help you. Call us before you do your deal, we can talk to you. And then maybe there's a structuring. Maybe we can do the C Corp blocker. Maybe you can structure it as a loan. Maybe there's a convertible note option, right? We have ideas. We've been doing this for 14 years, right? 20-something plus thousand clients, over $5 billion in assets, total investments with IRAs and 401ks, over $3 billion just IRAs. So we've been here. We can help you. We're the experts. I've written 8 books on this. Like, if you talk to my team and you just can't get the right answer, you'll reach out to me. They'll get me, and they'll get my colleagues, and we will get you the right answer. Okay, it's not just me. I got a team of amazing professionals that we work together and get you the right answer. So let us know. We're here to help, and we want to help, but you gotta let us know. Okay, so I appreciate you guys watching. Try to keep it relatively short, but I can talk about this stuff for hours and hours and hours and hours. So I appreciate everyone. Thanks for spending some time with me today. I know there's a lot better things to do. Spring is hopefully on its way. St. Patty's Day is next week. People are on vacation, spring break. So I know things are going on in the world, but I think this stuff's really important. This is your life. This is your retirement account. Most Americans, their greatest asset is their IRA. Okay, and we just got to spend more time focusing on it. Yeah, you can ask a question if you have one, Ron, but real quick, because I'm about to finish. But people, can you call me? Well, yeah, email me, Ron, and I'll call. Email me and we can chat. It's probably easier that way. But I have an open phone, open email policy. I'm not the Pope. Anyone can reach me if you want to talk to me. I may not give you 3 hours of my day, but I'll give you 10, 15 minutes. Even if you're not a client, if you have a really good question, I'll chat with you, okay? Because I'll learn something from you. If it's a super easy question, I'll answer it in 1 minute, so I'm not worried. But if it's a pretty detailed question, even if you're using another company, I don't care. I'm happy to chat with you. And so is our team, right? We have a great customer service, sales executives. We'll talk to anyone. There's no fee to talk to us. And even if you're not a client, we'll get you the answer. Now, we hope you'll use our service and ultimately move your IRA. But basically, even if you don't, like, we want you to have the right answer. And that ultimately is the most important part of this. I've probably gotten more clients by just talking to folks, even who've ended up moving their account to us because they're like, Adam, or your team was so nice and spent so much time with me, even though I have an IRA with another company, I'm going to move to you because I see the type of service you give us. And that's what we do. Customer service is our strength. We have also an audit protection where we guarantee, it's like a lifetime guarantee of the structure. So if your structure ever gets audited, where the IRS says the self-directed IRA structure is invalid, it's still okay, like, not only get your feedback, we will fight you, fight the IRS and guarantee it. Now, obviously, if you do a prohibited transaction because you haven't called us and you just bought a house and live in it, I can't help you. But we will guarantee, lifetime guarantee, that the structures we set up are in full IRS compliance. Anyways, Ron, appreciate the question. Yeah, just give us a call or email me and I'll chat with you. Otherwise, have an amazing day. Thanks for watching, and I'll chat with everyone again next week. Take care.